Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Welcome to The Informed Investor, and today Jake is taking over moderating duties. Jake DeKinder.
I am taking. Welcome to The Informed Investor. I'm Jake DeKinder, very pleased to be joined by my colleagues Mark Gochner and Rob Harvey. This show is brought to you by Dimensional Fund Advisors, a global asset manager with over $915 billion under management, and a company that brings financial science to the world of investing. But I do want to introduce Rob Harvey, co-head of product specialists here at Dimensional. It's great to have you on the program. And
thanks for having me on the pod.
You spent a lot of time here at Dimensional and in a lot of different roles, so you bring a really good perspective. I mean, you spent time in London office, U.S. offices, been managing a lot of portfolios. Do you know why I'm hosting today versus Gochner?
It's because of his passion for the topic, isn't it?
He is going to totally geek out on this because we're talking taxes, baby, and he's going to totally geek out on this one. You're fired up for this one,
I am fired up for this one. I love it. I guess it goes back to my old days as a CPA. And by the way, you passed the CPA as well.
I did. I didn't do all the work requirements and all of that, but I did get my master's in accounting, sat for the CPA exam, so I can geek out a little bit with you.
Well, how'd you get in the room today?
I have my CFA. You have to do some accounting for that.
I guess. It's a lucky day for you to be here with two CPAs, I think.
Okay, this is going to be a fun one
All
on
right.
taxes.
No, it is a great topic.
It's a great
It's
wait,
a really
why
important topic.
Why are we talking about
it's
it right now?
It's an incredibly important topic.
This time of year, why are we talking about
this time of year. So this is distribution season.
Yep.
And by that, I mean the estimates for asset managers are coming out. Typically, you start to get those in October, November. And then distributions are made in December. And so we get a lot of questions here at Dimensional around the distributions. But again, asset managers are usually coming out with estimates, helping investors then think through their year-end tax planning. So a lot of headlines coming out now around distributions, a lot of questions. So it's just a good time to address it.
I like that. Was that a subtle reminder that as I do your job, I'm supposed to read the headlines?
Yes. See, it's harder than
Good
it
segue.
appears.
There you go.
I got a couple here for you, okay? Exchange-traded funds have a tax magic that many mutual funds don't offer. And actually, we're going to get into a little discussion about vehicle type, mutual fund versus ETF. A couple other ones here. Qualified dividends versus ordinary dividends. How are dividends taxed? Which, again, we're going to get into that one.
Yep.
Love it.
Yep.
And then are active ETFs truly more tax efficient? I actually think those three set up really nicely for our discussion.
They do. Yeah, we've got a lot to talk about for each and every one of those. So
let's start at a high level because I think a lot of people actually do think about taxes. Well, I think everybody kind of considers taxes, right? But on the investment side, a lot of people think about my 401k or some type of qualified account right off the bat. So people are thinking about this, correct?
They are thinking about this, and there's lots of different sort of avenues you can take from that high-level decision. But to your point, right off the bat, qualified versus non-qualified, that is an important aspect already about what kind of investments are you holding and what does a taxable account look like? Or in other words, what are you holding in there and how tax efficient is it? There's a lot of decisions that get made beyond that. But first and foremost, if you have a 401k, if you have an HSA, or if you have a brokerage account, you already know about a lot of this stuff or you're already thinking about it. There's a lot more depth we're going to go into, but high level, that's absolutely right.
So we're not really going to spend much time on that qualified because whether it's after-tax dollars that go in, pre-tax dollars, how it grows, how it comes out, there's all of that. People should be considering that if they have that option. Yes. We're going to focus on the taxable side. And Mark, when we go to the taxable side, what is it that you get taxed on? Like, what are the different types of taxes you can get taxed on inside of an investment?
Well, and it goes back, let me just set it up and go back to the timing again. I wanted to mention this one too about how distributions come out in December.
Yeah.
And largely that's a big interest because that's where capital gains come out in those estimates, right? You get quarterly income distributions. Usually the industry will distribute capital gains for the most part in December. And then in January, we get our 1099 reporting, which breaks out the type of gains you have in those taxable accounts. And that's exactly where you're going there is what are these different types of taxable events. And so usually there's two major ones. You got the capital gains, right, which is a realized gain on the sale of a stock or a bond. And then you get income. And that can mean different things depending on the strategy. It could be the dividends you receive. It could be the interest income on bonds. It could be even some income you receive from securities lending revenue. And we're going to get into it. And this is where I like the topic so much is the industry focuses so much on capital gains. And they should because it's incredibly important. But there's very little conversations on how to manage income.
Yeah.
And that in some cases can be just as important
Yep.
as managing capital gains effectively. So those are the two big ones there that we'll be diving into here today.
Okay,
Yeah.
so let's talk a little bit about the gain side of it first. Let's go there.
Yep. So you and I were talking about this earlier. From a gains perspective, there are things that an investor can do to influence what their gains are like, and then there are things that happen inside the investment product to mitigate capital gains. So we were discussing this earlier, but if you're an investor who's buying and selling a lot of different stocks, meme stocks, for example, or maybe you've got an opinion on crypto or maybe gold, right? Those things are very volatile. They're
Or
moving
even buying
quick.
and selling ETFs.
Or even buying and selling ETFs.
Yes.
Right? You will take capital gains if your investments have done well, right? And that's a bill you're going to have to pay.
Yep.
So there is the decisions that are being made by investors in these vehicles, but then there's also, well, if you do have a longer holding period, maybe something that's a core part of your portfolio, what's happening inside of that investment vehicle to mitigate some of those capital gains, which are ultimately going to be distributions, right? If it's not careful, if the manager's not doing a good job thinking about them, that's going to be a bill for you.
It's going to be a really big bill for you as well. And Mark, if we think about like the rates that we can potentially get taxed, and I know you want to go to the income side, but let's just kind of think about just the gain side of it. Walk us through some of the rates that people have to be considering, because if you go from short-term to long-term, it can be really big in terms of the difference on what you're going to pay.
Yeah, two major rates that we look at here. So what you'll find is the capital gain rate on long-term gains is 20%, but then there's also this thing which adds another 3.8% to capital gains. So long-term gains will be 23.8%, and then short-term gains are taxed as ordinary income. Now, again, the guidelines dictate that for ordinary income, you use the highest marginal tax rate, which is 37%. So the tax rate then on short-term gains will be that 37% plus the 3.8%, so it'll be 40.8% in total. And then similarly on the income side of things, qualified income will be taxed at that 23.8%. Non-qualified income will be taxed at that 40.8%. So we'll get into how to think about managing those a little bit here, but those are by and large what we'll be using here is 23.8% for long-term capital gains and qualified income, 40.8% for short-term gains and non-qualified income.
I think it also surprises a lot of people that they may continue to hold a fund, and yet there's gains that they might have to potentially pay, right? And that's because the fund is it's a company, correct? And I mean, if you invested in any type of company and they had a gain, like you would have to pay that as an investor. That's what's going on, correct?
Yeah, it's a good point. And we're kind of bouncing around a little bit between an investor holds an ETF or a stock, right? If they buy or sell that, they're going to have a capital gain.
Right.
Assuming, hopefully there's an increase in value.
But if they continue to hold, they can still have to pay, correct?
Yeah, so then if you talk about an ETF or a mutual fund, the managers are holding tens, 20, hundreds, thousands of securities within those, and they may be buying and selling depending on the objectives of the portfolio. So they're realizing capital gains, they're earning dividends and earning potentially income in there as well. So you're absolutely right. Those capital gains, the income earned within a fund, mutual fund or an ETF, are required to be distributed out to the shareholders. And then that's where these estimates come in that we've been talking about here. And then what you're going to have is on record date, which is usually in December.
What's record date?
So record date is when, if you are a owner of that mutual fund on record date, then you will get the distribution. Typically the following day, you have what's is called X date, and that's when then the fund distributes those realized gains and the income, and that's where you get that drop in NAV. So let's just remind folks, when you get a dividend or a distribution, the NAV drops just like you do if you have an individual stock, right? The stock price drops by the amount of the
And we had an episode on that.
And we did an episode in that.
That's
yeah,
right.
In fact, I think it was one of our first episodes.
It was one of the first ones, yeah.
That we did there. So just as a reminder, when you get a distribution, the NAV or the price of the mutual fund or ETF drops by the amount of distribution. You still have the same overall wealth, dollar value of wealth. It's just that share price drops by that. So we just always want to remind people about that because we still sometimes get questions of, man, what happened yesterday?
Yeah.
Well, we just have the distribution.
Exactly.
Yeah, we do
Yeah,
every year.
Okay, so I want to talk about the vehicle type. I want to talk about ETFs versus mutual funds because the general narrative out there is one's tax efficient, maybe one's not tax efficient. Just start with the ETF side of it, and historically, why has that argument been made?
Yeah, so first of all, I want to go back to something we talked about earlier. When you have gains, it's because the fund did well,
That's
right?
a good
So we're looking at this in an environment of, let's say the mutual fund and an ETF both did well. That's a
Right.
good thing, right?
Yeah.
Now you have gains. So how are those treated differently in the different funds? Well, ETFs have a mechanism called create and redeems. So it happens when you're sort of moving shares out of the ETF or into the ETF. And when you move it out, you can move low cost basis stock out of the ETF without taking
So ones that
capital
would
gains.
have potential
Ones that
gains.
would have big gains,
Yes.
right? If you were to sell them on
Unrealized
market.
gains.
Unrealized.
Unrealized
Yeah.
gains. So what we were talking about before is, as an investor, your cost basis in the ETF stays the same. So you still have gains in the ETF, but you're not taking a distribution because the fund hasn't actually sold something on market. And this is what gives the ETFs their sort of tax advantage from a distribution side. Mutual funds are kind of thought of as being less tax efficient, but they do have that tool available to them. The in-kind mechanism is really the big difference between the two, and it's one of the reasons why retail investors or taxable investors tend to prefer ETFs over mutual funds.
Yeah, that makes sense. Now, we should say that when you don't get those gain distributions in an ETF, or in the case that you explain in a mutual fund, then your basis isn't going to go up over time. It's not that you're going to avoid those taxes. The government at some point is going to want their money.
They will get their
It's
money,
just,
that's right.
You're not paying it each year in the form of gain distributions,
Right.
but down the road you could pay more, barring the fact that you get a step up in basis at death.
Right,
and all of those things,
generational
right? But
wealth transfer, that's possible, right? We'll talk about this with income, by the way, because this is not how income works. Your income is a bill at the end of the year. But you're right, it doesn't sort of magically make the gains disappear. They're embedded in the cost basis, or in other words, in the value of that investment versus where you bought it, right? So there is still an accumulation of the gains. You're just not getting that bill at the end of the year.
Yeah, I always like to think you're deferring them into the future.
That's
Yes.
right.
And so when you sell that ETF,
That's right.
That's then when you pay the capital gains on that value.
Okay, so we're sort of talking about gains inside of the vehicle there. We should make one other note too, is that at least a high level, I think you guys are kind of talking about, stock portfolios or bond portfolios, gains inside of there. So you just got to understand what's going on inside of there and why you may be paying either long-term or short-term gains, depending on how the fund is being managed and the type of investments they have. So, we've talked about the gains part of it and how we have to think about it. I want to come back to the income piece, because you mentioned this at the top, that the industry does tend to focus on this gain side over here, but the income can be really important, and it can get taxed in different ways as well.
It absolutely can. And I think there may be a view out there that's like, well, it's just income. We all get it, and it is what it is. But it doesn't necessarily have to be that way. There are things you can do to really bring a more tax-efficient approach in the way you're managing that income. But let's go back and think about, how do we even measure the effectiveness of a manager when it comes to their ETF or their mutual funds? And so there's a couple of things that I think the industry likes to look at there to see, is my particular mutual fund or ETF tax efficient? So one of them we just refer to as tax cost. That's simply the difference between your pre-tax return
And your after-tax
minus
return.
your after-tax return
Right.
on those distributions. So that difference is really how much you're losing in your return to taxes. So that's one measure. And then the other one is we call it the tax efficiency ratio, which is simply my after-tax return divided by my pre-tax return, and that is telling you the percentage of my total return that I'm keeping and after tax.
Yeah.
So let me just give a couple numbers, sort of give some context to what we mean by those numbers here. So I'm going to look at a couple of these major asset classes that we have there, and the data I'm mentioning here is coming out of Morningstar. And these are going to be 1 year numbers as of September 30th, just to give some perspective here. So here's some numbers here. So let's look at the asset class large blend. And the tax cost over the 1 year number has been 1.42%. So that means whatever the pre-tax return was, lower that by 1.42, and that will be your after-tax return. So that's your tax cost. And then corresponding to that was a tax efficiency ratio of 87%. So, sometimes it's easy. You need a scale by something to get comparisons here.
Right.
So that's the tax efficiency ratio. Now let's contrast that with the small value asset class here in the U.S. So that tax cost is 1.79, so quite a bit higher than that 1.42 we looked at. And the tax efficiency ratio dropped to 54%. Big drop. And we're going to talk again about the things you want to keep in mind in and what drives that lower number, particularly around income.
Yeah.
And then just give context outside the U.S. Let's stay with, in this case, Morningstar's categories, foreign, mid cap, small cap value, that goes up to 1.86% as a tax cost, which is about an 89% tax efficiency ratio. So just to give some numbers in terms of the way we think about the impact of taxes on those different asset classes.
Yeah, and those are big numbers too, by the way, right? You think about shaving 10% or more off of your returns in terms of what you're taking home. It's important, right? It's worth focusing on. So I think that's
and that's why I love the topic.
Yeah,
is it can have a huge impact negatively
yeah.
on your returns if you're not managing your taxes effectively.
So when you move from something like, I think you said large blend, right, which are bigger stocks that are kind of out there, into smaller stocks you referenced, then you moved outside of the U.S. Like, as I change those categories, I go to small and then I go, I was like, what is it that could be driving some of those numbers? I mean, walk us, is it turnover? Is it what they hold? Is it something else that's going on in potential taxes, especially when you get outside the U.S.? What's happening there?
Well, and this is where I'm going to bring Rob in. And by the way, Rob was portfolio manager on many of the different equity funds in the UK, our UK office, as well as here in the U.S. So just great perspective globally.
Different taxes.
Yeah.
Still taxes over there.
Different types of taxes. And so you're absolutely right, Jake. It could be the turnover, like how much you're buying and selling within the fund. It could be the type of securities because they have different tax treatments. So let's get your perspective here, Rob, on some of the things that come into play there.
Right. I mean, turnover is important, and it's also about when do you take that turnover and what are you turning over, right? So if you look at a fund that has maybe 5% turnover in a year, that doesn't necessarily give you the full story because we talked about long-term and short-term gains before, right? So if you have a manager who's holding the vast majority of their portfolio, but they're trading in and out of meme stocks, for example, and that's the 5% turnover, you got short-term gains in there. So that's going to impact you differently than if you had really looked at that 5% turnover and thought, where can I realize losses, for example, April of this year. If you took turnover in April of this year, you had a chance of realizing some losses, which is good, right? Ultimately, you want to kind of crystallize that and lock that in a little bit. So it's about when, it's about how much, it's about which stocks, right, in terms of the cost basis are also being, traded with the turnover. So that's true. But then the types of investments are also incredibly important. Mark, we talk about this all the time, but there are certain types of investments that have more advantageous tax treatment than others. And for us, thinking about, which type of vehicle, we mentioned this before, qualified versus non-qualified, is important to consider where am I holding these investments? REITs, for example.
Absolutely.
PFICs, passive foreign investment companies, is another good example of just things that are going to throw off a little bit of a higher tax bill. And so you have to be conscious about where you're getting that exposure.
And by that, you mean like REITs, for example, the income coming off a REIT that the fund earns, and again, by IRS guidelines, that's taxed as non-qualified income. So that's taxed at that 40.8% rate, right, as opposed to the 23.8% of regular dividends. So to your point about if REITs are in your portfolio or not, it has a huge impact on your tax efficiency. And I think that goes back to your question, Jake, of you generally see more REITs out there being small cap, small value, don't you? So that's where you really see
we saw that ratio,
that income ratio drop a lot in those asset classes.
Yeah, that's exactly right. Yeah.
Well, maybe comment on this then about.
Do you see how he has to be host?
He can't not do it.
Go, Doctor. Go.
It's so true.
That's right. Go, man. What do you got? What's your question?
Well, the question was going to be comparing and contrast then REITs. So some funds have the ability to exclude REITs. Others may not.
Right.
Like some of the indexes out there have to own certain things. They may not have the flexibility to think about sort of the tax aspect of securities like REITs.
Right. And the impetus really then becomes on the investor and the advisor, thinking about an index is a list of securities. And an index doesn't have to pay taxes. So they don't necessarily have to think about that because it's a paper portfolio. But you don't own a paper portfolio as an end investor. So you have to think about, sort of look through this and think, what is the impact for me? What is the take-home return that I'm going to realize, right? Because you think about an index, look, if you're investing in an index product, you're going to pay some fees. But then what we're discussing here is it's not just the fees. It's not just the capital gains about when you're exiting and entering that product. You have a bill coming at the end of the year. And what does that look like, right? That's important.
Okay, so high level, here's a couple things. And we should be really clear. We're not giving tax advice on here, right? These are just kind of logical things you want to think about with your money if you're considering how do I ultimately maximize after-tax returns.
Right.
So high level, we're thinking qualified versus sort of non-qualified accounts, correct?
Yes.
That's where we sort of started the discussion.
Yep, that's the beginning of the decision-making tree.
And then when we went over to the taxable side, we said sort of gains, and we said income and the things that we need. I guess the question for me is, as an investor, like, what are the questions that I should be asking, or what should I be thinking about or be on the lookout for as we approach this time of year, so that you're not caught off guard with, you're like, wow, that's kind of a big tax bill.
Yeah.
Well, yeah, and so maybe that connects back to kind of the original comments on the estimates.
Yeah.
So if you go to your financial professional and say, hey, what do the estimates look like? You'll get a breakdown on the capital gains between long-term and short-term. And I think most investors are probably pretty familiar with that one.
Right.
I think the one we want to highlight here is, as you think about income, what you want to look for is the QDI rate. Was that the qualified dividend income rate?
Yep.
I believe it stands for.
Yep.
And the QDI rate, the goal is always to have 100% if you can. That means 100% of that income is taxed at that 23.8%.
Right.
And then as it gets down there, then it drops quite a bit. In fact, let me just give you an example
Yeah.
of what that can sound like. I ran a couple numbers here. If I got my numbers right. In fact, I might have to get my glasses
That's okay.
for this one. All right, so let's just say you have Fund A and Fund B. All right, and both of them have a pre-tax return of 10%. Now, Fund A, on the dividend income, theirs is 100% QDI, or 100% of its taxed at 23.8%. Fund B has a 50% QDI rate. So that means half that income is taxed as non-qualified at that 40.8%. So if you run the numbers, the tax cost then, just on the income, we'll assume there's no capital gains here, is 48 basis points, or 0.48% on Fund A, versus 65 basis points, or 0.65%. So you're talking 17 basis points difference.
Yeah.
And that is absolute tax savings.
Right.
That is money in your pocket
Right.
to have that lower dividend income. So that's where I commented earlier about it does get so important. And so just as an investor, be on the lookout for QDI rates. You can go to any asset manager's website and just search QDI rates or dividend estimates, distribution estimates, I should say, and you can probably get those numbers.
It's good. And it's funny, on that 17 basis points that you said, 0.17%, right? Sometimes I talk to people and they're like, well, yeah, but that's not a big deal. I'm like, yeah, but you're going to be an investor potentially for the next 40 years.
Yeah.
That stuff adds up.
It absolutely does. It compounds. And by the way, like when we, I'd spend a lot of time talking about funds versus funds, and 17 basis points bridges the gap between a whole range of products. So if you can be more tax efficient and save some of that, absolutely makes an enormous difference. We're living in 2025 where 17 basis points does matter. People are really thinking about picking up every bit, fighting for every bit where they should be.
I love it. Guys, I love the discussion on taxes, and I think for some people when that tax bill comes or get concerned about it, can be a little bit scary, and that's actually going to lead us into what we're going to talk about on our next episode. We're in October. We got Halloween coming up, and this industry is really good at putting scary headlines out there to freak people out about investing. So that's going to be the topic of our next conversation. Mark, would you like to close, or do you want me to close?
No, you got to roll with this one.
All right.
For sure.
All right. Thanks, everybody, for taking some time to join us for the Informed Investor Scary Headlines. We're going to hit that next, and make sure you hit that button, hit subscribe, and tell your friends about the Informed Investor. We'll see you next time.